Hooty hoo, all my stock market gamblers. Welcome today. I'm Tall Mike. I'm so glad you're here. Well, what do we got going on in the markets today? Having a little bit of an update. The Dow's up about 40. NASDAQ's up about 130. We're having a little bounce. Not a lot yet. Now, I thought we'd get down to that 200-day moving average on the S&P before we hit the bounce. The bounce may be starting here. We may still come down and touch that 200-day and bounce off of it higher. That's just my take. The 20 week on the S&P is sitting at 4150. So you got a lot of support down below where we're at right now. We're at 4250 on the S&P. So we could come down as far as 4150, which would be the 20-week moving average. And I think we're going to get a bounce. I think we're going to get a bounce up to about the 4400 level. This is just my take. Yours may be completely different, but we're kind of getting in that oversold position off of the July high. We've come down about 8% right now on the S&P, but if you look at the Russell, which is the small caps, that's down about 15%. So that's pretty oversold, overdue for a little bounce up, but I do think the market will continue to head lower. Now, if you look at the stock market, you go back 2 years, we're lower than we were 2 years ago. This may be a whole decade of just a wasted stock market where we just kind of move sideways to lower, kind of drift downwards. That's a possibility, but I think we're going to come in. I think we're going to head a lot lower on the S&P. That's just my take. Yours may be completely different. All right, let's get over to the real estate market. Now, we got some good news. Good news if you're a home buyer, right? Zillow, they came out and said we're in the sweet spot. Sweet spot. Right now, we're in the sweet spot. Now, why they say that? Well, there's more motivated sellers out there right now, they say, and there's more active listings. Okay. Now, I don't think we're in the sweet spot. The sweet spot was when houses were 50% lower. That's where the sweet spot was. Right now, we're 50% higher. House prices are higher than they were before the pandemic. I do think the house prices will drop from here about 40 to 50%. And that'll put us back in the sweet spot. But according to Jeff Tucker, he's the big chief economist over there at Zillow, he thinks that we're in the sweet spot right now. Now, if you consider the sweet spot that you go out and buy a house and you're the bag holder, yeah, you're the sweet spot for the bag holder, right? I mean, you're going to basically be the only buyer left out there. Now it cracks me up. It cracks me up. I hear this all the time. I'm sure you hear it also, but it cracks me up, But Mike, our prices can't fall. There's no inventory. And now here's the thing. People think that no inventory is a bullish sign that house prices are going to go up because there's no inventory. I look at it as a very bearish sign that house prices are going to tank. I do agree inventory is restricted right now. It's very limited. But wouldn't that be sending house prices skyrocketing higher? Well, they're not skyrocketing higher. They're drifting lower. You wait till the inventory comes on. There's going to be inventory. A lot of that inventory is going to be for selling, right? It's going to be in the form of foreclosures. Once that inventory hits, the prices are going to come crashing down. But everybody's telling me there's no inventory is why we're going up from here. I'm telling you because there's no inventory is why this market is going to come crashing down. 40 to 50%. I know that upsets the Moon Boys. The Moon Boys hate hearing that the market's going to go down. They believe that Ramsey guy that we're going to the moon. I don't see it that way. I just don't see it that way. You see now in Bitcoin, right? When it was up there at 69,000, everybody's talking about diamond hands. Diamond hands. I never understood that. I didn't know what diamond hands were, But it meant that they were going to hold on to their Bitcoin with these diamond hands, meaning their hands were really strong. They were going to grip it and hold on to it at 69,000. Well, just drifted down, right? 25,000. Diamond hands became paper hands, right? It just kind of fizzled away. Well, right now, what we've got in the real estate market is a lot of weak hands. Now, people will tell you, but Mike, there's diamond hands out there right now because everybody's locked in. They're locked in at 2.8%. They got diamond hands. They're never going to let go of their house. I tend to disagree with that. You got costs rising. You got a lot of people people, as soon as they see the crack in the house prices, they're going to be dumping their home on the market as fast as they can. That's where all their net worth is tied up in. That's where all their equity is tied up in. Now, people don't think that that can happen. Now, believe me, it's going to happen. It's going to happen. Now, if you look back to the 2008 financial crisis, right? Well, a lot of people think that was caused by the subprime crisis, right? They were giving loans to anybody. Money was flowing freely, and anybody could go out and get a loan. They made a lot of bad loans, and people couldn't pay the loans back. But how many homes do you think were really actually foreclosed upon? Anyways, it was about less than 2%. Less than 2% of homes were actually went into foreclosure. Less than 2%. We're going to explode past that number this time. Look at they didn't let the market crash back then. It only went down 34%. And 34% was not a flush out. They started printing money as fast as they could, right, to blow the bubble back up. And that's what they've done. And the money's flown freely. Anybody can go out and get a loan. But in 2008, the problem wasn't so much the foreclosures. You see, only 2%. You see, right now, foreclosures would be a good thing. If a bank could foreclose on the house, they could get that 2.8% loan off their books, and then they could sell the house and get that 7.8% loan back onto their books, right? So foreclosures would be a good thing for the banks. But the banks are in so much trouble right now, it's ridiculous. And that was the problem back then. The banks were in trouble back in 2008. That's where you had Lehman Brothers went under, right? Bear Stearns, well, technically Bear Stearns didn't go under. It was bought by J.P. Morgan for pennies on the dollar. J.P. Morgan took all the assets, and then they gave us all the liabilities. The taxpayer, we were on the hook for that when the Bear Stearns went over to J.P. Morgan, right? And there was that one, what was that bank? Washington Mutual. That was like the largest bank failure in U.S. history, right? Was Washington Mutual. That was actually my bank. I had money in there. Well, what happened to it? Well, once again, who got the assets of Washington Mutual? Well, it was J.P. Morgan. They bought the assets for pennies on the dollar, right? And who took the liabilities? Once again, the taxpayer. Technically, the FDIC took the liabilities of Washington Mutual, but the taxpayers' money was involved in that transfer over to J.P. Morgan. So everything gets transferred to J.P. Morgan, you know. Jamie Dimon, he's like a god, but don't be surprised if one of the big banks goes down. Don't be surprised if J.P. Morgan goes down. Now, of course, they're too big to fail. They're going to bail them out. Once again, it's going to be the taxpayer number. But what really happened with Washington Mutual? You know what happened? They got their bank downgraded. Once they got their bank downgraded, they had 9 days. 9 days. It took 9 days of bank runs to make the bank insolvent. FDIC had to take it and give it to J.P. Morgan. Okay, so what's happening today? Well, the banks are getting downgraded, right? And they're getting bank runs. Bank runs are happening right now. Banks are in a lot of trouble. Okay, people don't really grasp this. They don't grasp how this comes to the real estate market, how this is going to make the real estate market a very desperate market where sellers have to sell. But Michael, everybody's locked in at that 2.8%. And I get that. That's not the problem. The problem is there's going to be a credit crunch, right? Okay, so the banks are getting downgraded. There's being bank runs, and the FDIC openly admits that there's hundreds of banks that are going to go out of business. They're going to have to be merged together. They don't call it a takeover. They're merging them together. You know, the bad bank and the good bank are going to merge. It's not like the bank goes under. It's not like the bank goes out of business. But there's 200 banks that are going to fail. They won't give you the names of them because if they do, you'll have a bank run just like they did at Washington Mutual when that got downgraded. Look, the banks are in major trouble. There's going to be credit market is going to lock up, right? And this is what happened back in 2008. That's why homes dropped 34%. 34%. And we're going to drop more than that, probably 40 or 50% when we get the credit market locked up today. You see, they're coming out with this now, and they're saying that, you know, the banks are being downgraded. We're having the bank runs. We're going to have a credit crisis. It's just what's going to happen. And right now, we're already reaching desperate times times in the real estate market. In the real estate market, we're in these desperate times. What am I talking about? Well, the traffic. Okay, so the traffic is just falling off a ledge. And this is just in the last few months. Now, it's really a strange time to have listings hitting the market. They're hitting the market, the listings right now. It's a weird time, right? We're coming into the holiday season, Thanksgiving and Christmas, but people are dumping their house onto the market as we speak. Listings are going up. People are getting desperate. They don't have any money. They got to get the equity while they can. They can't go refinance because they lose that 2.8 into a 7.7, so they're putting the house on the market. So listings are going up, right? And sellers are motivated. Sellers are motivated. This is coming from Zillow. Zillow doesn't want to say there's motivated sellers because motivated sellers means the prices are coming down, but the traffic is falling off a cliff. There's no buyers. Look, you want to be a buyer? Now's a good time, right? Because you're going to be the only one, but you're still going to be paying the price that Billy Bob got. You don't want to be paying the price Billy Bob got. I'm telling you, that is the top. That's the top. We're coming down. Okay, so traffic and new homes, the new home builders, their confidence is going way. They used to have a lot of confidence, right? They were 1/3 of the sales being made by new homes. The home builders had really high confidence, but now, their confidence has gone away. Why did their confidence go away? Well, nobody's coming to the open houses. Nobody's coming to buy the homes, right? So on new homes, they're already down about 15%. That's just what they're admitting, right? That doesn't take into account all the concessions that they make. They're paying their loans down. They're buying those loans down from up here around 8%, right? And they're buying them down. They're buying them down. That's probably another $5,000, $10,000, $20,000. So that number of 15% is probably more like already down 20% on the new homes. But the new homes, they're smarter because they're in the game. They see what's going on. They see what's coming in the future. They see that there's no buyers. They want to get the last suckers while they can. And those poor guys with the existing homes, they come onto the marketplace and they're just sitting there because they're not lowering the price enough. So they're getting more inventory. Listings are going up, right? Okay, so that's all happening in the new home market is coming down 20% already. Existing homes, they're just sitting there. Pretty soon, you see what they want. That guy wants to get the price Billy Bob got. That's what he's waiting for. He's waiting for someone to come in and offer him the price that his next door neighbor Billy Bob sold. That those days are gone. You're not going to get that price. I'm telling you, the longer you wait, the more you're going to have to come down. But Mike, there's no inventory, and that's my point. Prices are coming down with no inventory. Pretty soon, there's going to be a lot of inventory. A tsunami of inventory is going to hit the marketplace. Then you want to see how far prices go down. Oh, that's going to make them go up, Mike. The Fed's going to pivot. Look at the Fed probably will pivot. If you look at history, when the Fed pivots, that's where the bad stuff starts to happen. Look at the 2-year note right now. The 2-year note is paying 5.14. 5.14. Okay, the 10-year low is coming up, right? 4.8. It used to be down here, but now the 10-year is coming up. So once these reinvert, that's where the bad stuff is going to happen. The bad stuff in the stock market, the bad stuff in the real estate market. Look, you can get close to the price Billy Bob got right now. I mean, that's like within 10%. But if you wait, you are not going to get anywhere close to that price. People are going to get desperate. There's a lot of people just waiting to dump their homes on the market. I'm a real estate broker. They're calling me. I know about these people. A lot of them are old people like me that are getting retired. All their money's in their home. If they don't sell their home, they're not going to be able to live. They don't have any money. That's where their money is. They want golden years, their retirement years to be golden. But if they don't sell the house and get the cash, they're not going to be able to have the golden years. So a lot of people are selling right now. Now, it's funny to me. Okay, JP Morgan, right? All right, Jamie Dimon. Everybody loves Jamie Dimon, right? Well, anyways, they made two predictions. Number one, they predicted that the Fed funds rate is going to hit 8%. 8%. Could you imagine that? That put mortgages over 10%. Now, I've been saying that for over a year, that mortgages are going to go up to 10%. When they were down here 2.8, I'm saying you're going to see 10%. But Mike, you're crazy. Everyone's telling me I was crazy. The Moon Boys hated that. Hated that I was saying 10%. I'm still saying 10%. You're going to see 10% mortgages. We're up here at 8% now. But we're going higher. We're going to 10%. JP Morgan came out and said the Fed funds rate's going to go up to 8%. That's crazy. And what they also said, which I don't even understand, maybe you can leave a comment, there's going to be a financial accident. What I interpret that is there's going to be a nuclear meltdown, right? It's going to be the credit market locking up. They call it a financial accident. It was an accident. We didn't mean to do it, but you're going to get this credit locked up. Nobody's going to be able to buy a house. You're going to have all cash to come in and buy a house. You know what that's going to do? It's going to cut the price in half, probably a lot more if it actually happens that way. If we get that credit crunch, the houses are just going to free fall. I mean, there's going to be no buyers. There's no buyers now. I mean, the demand is gone at these prices. Nobody can afford a house, so there's no demand. And when you get the credit crunch, it's going to be no buyers except for that cash guy. You know what that cash guy's going to do? He's going to offer you about 50 cents on the dollar. Now, I know I'm going to get a lot of hate comments. Moon Boys, get in the comment section. Leave me those hate comments, but first, give me the thumbs up. Why not? Punch the subscribe button. Why not? Share it with a friend. Why not? Get out there, everybody. Enjoy your day. I'm Tall Mike. Bye-bye now.